Hey there. So can you hear me? Yes, you can. Welcome to the look ahead for the coming week, which is the 21st of October, with me, Fiona Cincotta, Senior Market Analyst at City Index. So as always, just before we start, I'm just going to ask you to read through the risk warning. I will pop myself on mute whilst you do that. Okay, brilliant. So let's just crack straight on. I think it's worth just having a quick look at what we've seen this week. I think actually just let me put that onto the daily chart. We this week has been a fairly important week in the sense that we've seen another increase across the week in the US dollar. So if we just have a look at that rebound in the US dollar, it is pretty impressive. 3 straight weeks of gains, basically on a couple of points here. Firstly, we've seen solid US economic data, which has supported the view that the Federal Reserve will cut interest rates, but probably at a more gradual pace. In fact, we even heard Atlanta Fed President Raphael Bostic saying that he only sees one 25 basis point rate cut this year. So the market's actually looking at two, one in November of 25 basis points and one in December of 25 basis points. But we can see that the US dollar has rallied really quite impressively. It's just run into resistance at that 200 SMA. Just whilst we're quickly recapping what's been going on, I think it's also worth pointing out what's happened in the US stock market. Obviously, we've had earnings season kick off. And we've had the expectations of the Fed cutting interest rates, but more gradually, but stocks have still managed to reach fresh all-time highs. Just the other point to make as well, actually, with regarding to the US dollar, sorry that I didn't mention, the other thing that we're seeing coming into play a bit now is obviously US elections, and that concept of the Trump trade has also helped the US dollar as we go sort of tick down towards polling day on the 5th of November. Poly markets, odds bettings markets are giving Trump the lead, although the national polls are still giving a very slight lead to Kamala Harris. I think at the end of the day, it's a very tight race, but Trump is expected to cause more inflationary policies or put in place more inflationary policies, which is why we've seen the US dollar moving higher on the back of that also Trump trade. So I think just let's kick off. Actually, it's quite interesting because next week is actually quite a quiet week as far as US data is concerned. There is very little sort of big US data which is due to come in. So again, that's pretty similar to what we've seen this week. I mean, the only big US data that we saw this week was US retail sales. So what we do have is the PMI data, US PMI data, which will keep the US dollar and rate cut expectations in focus. We're expected to see ongoing contraction in the manufacturing sector and continued growth in the service sector. So, you know, again, as long as we're getting that data in that's supporting that Goldilocks view that the Fed can continue to cut rates, albeit gradually, and the US economy is performing well and by no means collapsing, but inflation is cooling, then that's going to keep everything nice and steady. We're going to see, you know, potentially stocks pushing on to further highs, and we could see the US dollar potentially just add a little bit of gains, particularly against those economies which aren't potentially performing as well, and where the central banks are expected to be cutting interest rates. Now, obviously, it's also worth mentioning, whilst we're talking about US stocks, that we've got US earnings season, which we are moving really into the thick of it over the next couple of weeks. So far, I think it's fair to say earnings, especially banks, has been upbeat. We've seen some strong performance from the banks. We've also had solid performance from Netflix overnight. Next big name that we'll be watching out for will be Tesla. Tesla is set to report earnings next week. I believe they're on Thursday. And basically, I mean, they'll be quite interesting because they come at a difficult time for the share price. I mean, if we just have a look here, I think this looks better on the weekly chart, actually, so just bear with me. That we can see on this weekly chart, we've had this massive fall off here, and that was the robo-taxi investor day, which was actually very disappointing, left a lot of questions, and so, I mean, we're coming into these earnings with that in mind. Tesla is trading above that falling trend line, which dates back to 2021, did move above it, but we could be coming to test it now. Now, just as far as the earning report, so it's on Wednesday next week after the closing bell. The report basically comes after quarterly delivery data and the robo-taxi unveiling sent the share price lower. Expectations are for quarterly revenue to actually rise to 24.41 billion from 23.35 billion in the same period last year, and we're expected to see profits fall just very slightly from 1.68 billion to 1.85. Sorry, expecting them to fall to 1.68 billion, down from 1.85 billion a year ago. So that's basically EPS. We're expecting it in at 48 cents, down from 53 cents. But as I said, you know, it comes at a time where we've seen third quarter deliveries, which were actually above estimates when they released earlier this month, but they failed to sort of spark any boost in the stock, just like the previous quarter's numbers did. And, you know, so I think it's a step in the right direction, but I think the market was hoping that Tesla would beat projections by a wider margin. As I said, we've also had that spotlight very much on the robo-taxi event, which saw the EV makers, it was basically disappointing. The self-driving software could be improved. Again, it was a step forward towards autonomous taxi becoming legal to operate, but there was a lack of details about whether Tesla would operate the fleet or sell them to customers. So I think, you know, it's a lot of uncertainty there as we head into the earnings from Tesla. As far as the chart is concerned, look, we saw that aggressive engulfing bearish candle take down the 200 SMA. The level I'll be watching for next is here. It's at the around the 207 level. So that's the 100 SMA on the weekly chart. It's also this falling trend line support dating back to 2021, and you know, if that does happen, then that we'll be seeing a double top formation there, with the next level on the downside down at 184. So just going to pull up the S&P again, just whilst we have a quick look there to check out what's going on. No, I don't want the weekly. We'll go back into the daily here. So S&P, yeah, as I said, it's moving to fresh all-time highs this week. It's not in overbought territory. It's risen back above this rising trend line that goes back to the end of 2023. So, you know, there is potential for this to continue going higher, blue skies above, as the market looks towards eventually that 6,000 level. Just on the downside, be watching out for this level here. this is the 63.85 level. A break below there is really going to create a lower low towards the 100 SMA there at 55.50. The Dow Jones also saw a record high, I do believe, last week. Again, you know, we've got earnings in focus. We've got this, we've got the ISM data. So as long as we continue with that Goldilocks scenario, then, you know, then the stocks could continue pushing. The Dow will be looking towards the next round level, which is that 44,000. It trades above this rising trend line that dates back to March 2024. Also, just the near-term rising trend line as well, trading above that. Again, not in overbought territory yet, but could be close to it. So just worth watching out. Just whilst we're continuing to talk about the US, let's take a look at gold, because gold is at fresh record highs today. It's risen to a record high of 2,714, so just below the $2,715 per ounce. Now we're seeing this boosted for several reasons. Obviously, expectations of continued monetary policy easing by central banks across the globe, not just the Federal Reserve. We've also seen the ECB cut rates as well. We've also got uncertainty as we move towards the US elections. I think US elections are going to be coming more and more in focus as we head towards that 5th of November focus. As I said, the odds and the polls are still basically showing, I think, if you compare them, that the races is extremely close. And given that they're diverging policies between Trump and Kamala Harris, it does mean that there is quite a lot of uncertainty about what could be expected next as far as the US economy and the policies that the government will be putting in place. As I said, Trump is expected to be considered more of an inflationary presidential policies on, you know, taxes, tariffs and immigration compared to Kamala Harris, but there are certain sectors that might perform better under each of those candidates. So it's just worth checking that out on our hub for the US election on the website. And also geopolitical tensions remain very much in focus as we've got the ongoing war in the Middle East, which is not showing too many signs of slowing, even though President Biden has said that he believes it's now time for the war to end. So between central banks rate cutting, uncertainty surrounding the election and geopolitical tensions, oil prices are, you know, could be supported higher. But I think technically we just need to watch out because they're in overbought territory on the daily. They're also in overbought territory on the weekly chart. And I do believe they are also in overbought territory on the monthly chart. Yep. So do you know that is reason to be cautious if you're buying into gold? We could see some consolidation or at least a move lower to keep the to get the gold price out of overbought territory on the different time frames. Also just worth talking about oil whilst we're talking about troubles in the Middle East. Obviously we had some data in from China today as well, where the GDP was a little bit stronger than expected. It was still the weakest GDP in 18 months, but it was still stronger than expected. Hasn't really offered too much support to oil prices. We've seen that oil has struggled since we've heard that Israel said that it wasn't looking to attack oil infrastructure in Iran. And so since we've heard that reports, that sort of took some of that risk premium off oil, because part of what that rally was expectations that Israel could attack Iranian oil infrastructure. So we've seen that we're back into this zone that we've been trading in for quite some time. It feels quite familiar. On the upside, you got the 71.50, 72.50 resistance zone. And then on the downside, just be looking out for this level around here, which is the 67 sort of 30, 67.25 level, and then below that 65.60. I think the fact that we didn't manage to break above the 200 SMA and we rebounded lower off that 100 SMA and that we've moved below the falling trend line, there are quite a few bearish signals on that chart. So sellers will be looking to push lower towards 67. So that's what's going on the US, and as far as sort of big themes are concerned. Next thing let's be watching out for here is, let's have a quick look at the Bank of Canada. That is the what am I doing? Bank of Canada is got their interest rate decision next week. Let's just confirm the date. When do we say that was? On the Wednesday. We've got the Bank of Canada interest rate decision. Now the Bank of Canada is widely expected to cut interest rates by 50 basis points on October the 23rd, and that's as price pressures in the economy have really eased. We've seen headline inflation decline by more than expected. It fell to 1.6% last month, and that's come with sort of, you know, other signs of a slowing in the economy. As a result, the markets and economists are convinced the central bank will opt for a 50 basis point rate cut, and that's adding to the 75 basis points worth of cuts which have already taken place. So, you know, the Bank of Canada is really quite cutting, expected to continue cutting quite aggressively, which is in sharp contrast to the Federal Reserve, who were expecting to cut interest rates potentially at a more gradual pace, and that has helped the US dollar, Canadian dollar rally from the low that we saw in September of 134.20, risen very sharply above the 20s, the 200 SMA, the 100 SMA. Didn't quite manage to make it across this rising, or a close above this rising trend line, which dates back to February. But that's what we're looking at now. We're sort of just struggling around that 138 level, which is just under 138, which is also that sort of rising trend line support. If we get a rise above that, buyers will be looking to push beyond there, and also the 138.40, which is this week's high, to bring 139 back into focus. If we get, for example, weak US data next week, is a very weak US data print, and we see the strength in the US dollar give up, then we could see the pair fall lower, or indeed if we see a 25 basis point rate cut from the Bank of Canada, but I just think that's a little bit unlikely. On the downside, 137.50, that's the weekly low. And then below there, we'll be looking at around the 137 mark as a round number, before falling down here to the 136 level. So they are the levels to be watching for on that side. Let's just have a look. The other thing, obviously, that's playing into this weakness is that falling off of the oil price that we've seen as well. So also worth keeping an eye on oil prices with regards to USD CAD. So we've got a speech from Andrew Bailey. That will be interesting, as well as we've got UK PMI data, which is due later in the week. Do you know what? I'm just going to double check, because I believe we also have, actually, whilst we're on central banks, I do believe we've got the Bank of Japan, but sometimes that doesn't come up in the high. So let's just double check here. Usually on a Friday. Maybe I'm wrong, but I'm pretty certain that we've got Bank of Japan. No, apparently not. Let me double check that one. Well, whilst I double check that one, let's just focus on something else. We're just going to focus on the pound US dollar as we're looking at speeches by Bank of England Governor Andrew Bailey. Obviously, I think his comments are going to be really closely watched given the cooling inflation that we saw this week. Inflation in the UK eased to 1.7%, so below the Bank of England's 2% target. We've also seen service sector inflation eased to 4.9%, down from 5.6%. That's the largest fall in service sector inflation since 2020. And so this data supports the view that the Bank of England will be cutting interest rates in November by 25 basis points, and the Bank of England may potentially cut interest rates again by 25 basis points in the December meeting. Now, let's not forget that Andrew Bailey did say at the beginning of October that there was a potential for the Bank of England to cut interest rates more aggressively if inflation data allowed it. And, you know, it's certainly moving in that direction, although it's not quite there yet. So his comments will be really closely watched. If they are hawkish, if we do have some hawkish, dovish comments from Bank of England Governor Andrew Bailey, then this is the level to watch, the 130 level. We've managed to just peak below it, but we haven't really had a meaningful move below that. And if we do, then watch out for 129. That's the rising trend line support ahead of the 128-200 SMA. Obviously, if we get very weak UK PMI data as well, that could also have an impact on the expectations for Bank of England rate cuts. Today we did just see that UK retail sales were that little bit stronger than expected. So also next week we've got Eurozone inflation. Okay, so now I've completely just busied my filter, so let's just unbusy that by putting hi. There we go. Okay, so we've got Eurozone inflation, and we've also got German PMI data. Sorry, ignore the idea about inflation. Sorry, we've got just PMI data from Germany and from the Eurozone. Okay, now this is going to be really important because we saw that the ECB cut interest rates by 25 basis points this week, which has put pressure on the euro US dollar. There wasn't any guidance for another rate cut in the next meeting. However, the ECB are expected to continue cutting rates as the growth outlook for the region remains pretty weak. So this PMI data, particularly we've been concerned about Germany and a contraction in Germany, will be quite key as to guiding for whether we could expect further rate cuts from the ECB. With inflation below the 2% target, it does make sense that growth is the key focus for the central bank to make sure that it stabilizes a deteriorating outlook, which could mean further rate cuts. And as a result, that's put pressure on the euro US dollar. Okay, obviously we've got that USD strength as well. So if we get weak PMI data, we're below the 200 SMA at the moment. Next level to be watching here is the 108 and also the 107.75. That was the August low. Below that, we've got the 107.60, which is the rising trend line support. And then, you know what, there isn't too much in the way of support down to the 106.70, which was this low that we saw back in June. So they're the levels that sellers are going to be looking to take out if we get increased US dollar strength and weakness in the euro. On the upside, any recovery really needs to retake the 200 SMA at 108.77. And then above that we've got the 109 level, but this 110, you've got to get above the 110 in order to negate this near-term sell-off that we've seen. Okay, so there isn't a Bank of Japan meeting next week. I just wanted to check that. So it's towards the end of October, actually. So there we go. So that's what to be looking for. Let's just have a look at what's going on in the DAX whilst we're here. DAX had been trading around all-time highs, as we've seen. You know, it's similar to the US stocks, boosted by expectations of lower interest rates, not only in the ECB and the European Union, but also in the US as well. And then you've got the idea of stimulus in China, or at least, you know, some sort of optimism surrounding growth there, although as we've seen, that hasn't really necessarily been the case in China, where there have been some questions over will the support be enough. But just before we move on to look at China and Hong Kong, this continues to trade above the rising trend line. This is a bullish chart. There's no oversold territory, so you know there's reasons to be looking towards 20,000 as the next move higher. On the downside, immediate support there at 19,500, then down at the 19,000. In order to create a lower low, we'd need to break below the 19,000. So let's now just have a quick look at what's going on in China. This is quite a special chart, isn't it, with that jump in and then pull back down. So, you know, we've had that data today, obviously stronger than expected growth in China, which has helped it push back above the 13,500 support, which was in play from here. I mean, just on that level, isn't it? It's not necessarily comfortably over it, but that's the level that bulls are going to need to stay above in order to drive the next move higher, which is the 14,400, and that was a level back from here back in January 2023. Not so much data-wise going on from China next week, but obviously any announcements surrounding stimulus and what, you know, any additional stimulus is obviously going to be a strong driver for that market. And then we've also got the Hang Seng. Again, you know, similar sort of patterns going on here. We had that recovery from the 200 SMA, ran into resistance, 23,500, fallen sharply lower, and it's just sort of hovering around here. We've managed to hold, I'm just going to move that actually. Oh, not that one, that's not what I wanted to move. I wanted to move the support level there, because that's quite an important level just around the 20,000, which is what caught the sell-off on the way down, offered support back above now the 20,300. Again, this is a level that we've seen back in July 2023. So that's holding at the moment. Not so much in the way of data, as I said, so be looking for stimulus announcements in order to be driving that. And then we will also, let's have a look, Tokyo Consumer. So we don't have Bank of Japan. We don't have Bank of Japan interest rate decision, that's at the end of the month, but we do have Tokyo inflation. We had inflation from Japan this week. Today, in fact, was a little bit cool. It cooled for, I think it was the first time in 5 months. So, you know, that's a sense that inflation is just a little bit cooler. That 2.4%, that was core inflation, down from 2.8%. We'll be looking at the Tokyo inflation, which is often a good gauge for the national inflation as well. But look at this chart. This is the recovery in the US dollar compared to the yen, which is deteriorating, as we saw that U-turn from the new Japanese Prime Minister, who suggested that rate hikes is not the appropriate environment to be hiking rates further for the Bank of Japan. And we've got sort of, you know, that sense of a little bit of weak data in the inflation levels means that the Bank of Japan doesn't have any desperate need to be hiking interest rates any time soon. Well, yes, soon, but just not this week. next week, sorry, on the 30th of July, 31st of July. So on the upside, I think we can expect to see this move into the fib level at around the 150.80 level. That's also the 100 SMA. You've got the 200 SMA there, just above there at 151.35, and then you've got this rising trend line that goes back to 2021, or is it 2023? And then above there, we'll be looking at this other fib level, which is 153.40. We do see some US dollar weakness on the downside, watching out for the fib level. You've got the 38.2% retracement there, and then you've also got the 146.60, which was the low that we saw back in March 2024. So they are the markets that I will be watching next week. I hope you've enjoyed what you've seen, and if you have any questions, then please do ask. Otherwise, I'll see you next week.